Hello and welcome to the efficiency ratio class for the Big Trends Indicator Library. My name is Scott Downing and I'm going to be the instructor for this session. Now, the efficiency ratio is a unique indicator that we use very often here at bigtrends.com, and the whole goal of the indicator, as it was developed by Price Headley, is to try to determine the most efficient way to put your capital to use in the markets. Obviously, we're looking for trending markets as those tend to be the most profitable compared to range-bound markets. But in those trends, you want to find the most efficient part of that trend to be able to trade it so that you're putting your money to use in the best place and eliminating as much risk as you possibly can in doing so. So let's go ahead and get started here today. I do want to remind you that access to Big Trends and its coaching services is provided for educational and informational purposes only. Now, the information presented here does not constitute a recommendation to buy or sell any particular investment. So what we're dealing with today is the efficiency ratio, and to fully understand that, I want to quickly review just the general concept of efficiency, what it is and why it's important in trading. And so to do that, I want to pose a question to you, and that question is, of these two trends that I'm getting ready to plot on the screen, which one of the two would you rather buy a bullish position? First of all, we have just the solid blue line that goes from the bottom to the top. Not a lot of movement, just a slow, consistent line. Or the red. The red, obviously, it has an uptrend followed by a downtrend, up, down, and then back up. So there's a lot more movement there that happens in the two. So the question is, of which one of these two would be the most efficient for you to trade on the bullish side? Well, the answer to the question is ultimately the blue. And the reason for that is the red line, although there is a lot more movement from point A to point B, it is not the most efficient movement that you're looking for there. If you're an options trader, you're going to have a lot of added volatility and a lot of added premium to your trading. Plus, let's talk about it from a practicality standpoint. How much easier would it be to trade line A, which is the blue line? It'd be a lot more simple because you don't have to worry about all these short-term tops and bottoms. It is just a smooth, efficient trend from the bottom all the way up to the top. Contrast that with line B that's very choppy and continues to go back and forth. And practically speaking, how realistic is it to say that you're going to be able to enter the trade at the bottom initially, then you're going to be able to ride it up all the way to that first top, then you're going to be able to ride it back down and exit at all these intermediate tops and bottoms. You know, I mean, we're traders, but we're humans, more importantly. And humans make mistakes. Yes, there's a lot of opportunity for you to catch a little bit of a move here, and then a little bit of the first down leg, and then a little bit of the next up move, but it makes it much more difficult. So at the end of the day, it's a lot easier for you to just jump in and trade that smoother, more efficient trend all the way up. So that's kind of what we're looking for here today, and that's what the efficiency ratio will allow you to do, is find some of those more efficient trends. As options traders, as I mentioned, you want to seek the blue trend, and really as a trader in general, it doesn't matter what you're trading. The efficiency ratio, just like all of our other indicators here in the indicator library, it can be used to trade any type of security. So you could trade stocks, ETFs, options, futures, foreign exchange, whatever you wanted to trade. The efficiency ratio can be very, very helpful there for you, because in any type of investing, you're looking for the most efficient way to put your capital to use, and the efficiency ratio will help you with that. It does that by sorting out what we like to refer to as some of the noise in the market, and in doing so, it only gets you on the best trending phases, or the phases of a move that are most likely to be a solid trending phase. Finally, you know, there's a couple different ways that you can use the efficiency ratio. Some people like to use it as just a filter for their system and kind of narrow down the list of stocks or ETFs that they may be looking at any different point in time. and just focus on the most efficient ones. And then from there, once they've filtered everything down, they use their different indicators that they have in their system to actually quantify whether they have any buy or sell signals. It can also be used as an indicator in your system instead of a filter, an actual trigger for a buy or sell signal. And then you can ultimately use that for trend identification, similar to how you would have with %R and acceleration bands and some of the other indicators that we have here in the indicator library. So now that we understand that whole concept of efficiency, I want to share with you the formula for the efficiency ratio so that we fully understand how to calculate it here. Now, don't get too bogged down in the math here if that concerns you. We do have the formula already coded for many charting platforms that are out there, so we can always get that information to you if you want to just have a little easier access to it. Give us a call at 1-800-BIG-TRENDS or email coach@bigtrends.com and we can get that information to you. But quickly, just for our purposes here today, the efficiency ratio, we use a 20 bar setting. And I'll review that in just a minute, but ultimately with that 20 bar setting, we're looking at the past, obviously 20 bars, and in this case, we'll say days, so the past 20 days. So what we're looking at in terms of trying to find an efficient trend is looking on the bullish side to have a series of higher highs. So you want the most recent close to be higher, exponentially higher than the close of 20 bars ago, and so on and so forth. So here's the formula. You take today's close and subtract the close of 20 days ago. That's your numerator. And then you divide that, so your denominator down at the bottom is you sum the absolute value of each day's close in that 20 bar, and then you subtract from that the prior day's close. It is a little bit of a complex formula, so let's go ahead and just jump into some of the rules as far as entry and exit. Like I said, if you do actually need the formulas, let us know and we'll be more than happy to get those to you. So as far as the entry and exit rules that we have here, remember we do start with a 20 bar setting, and that is the default setting. Now, we have tested other different time frames. We don't really like to go under a 10 bar setting because there's just too much noise, and the whole point of this indicator is to filter out some of the noise. So anything under a 10 bar really doesn't work well. We've tested all the way up to a 30 bar because, as you know, we use a 30 bar setting for our %R. And we found that both a 10 bar and a 30 bar setting can be profitable. And there can be some successful uses to those, especially if you're using them just more of a filter than an actual entry or exit signal. Then you might want to try to backtest this particular indicator on one of those other settings, a 10 bar setting or a 30 bar setting, and try to see if that would be able to improve any of your signals that you're getting. But for those of you who would like to use this indicator to actually signal your entries and exits, the 20 bar setting is the most efficient way, pun intended, to use this particular indicator. So we default it to a 20 bar setting there. So the bullish rules on the entry side, we look for an overbought reading of above 30. Now you remember with %R, we have the extreme levels that we look at, which would be 80 on the bullish side and 20 on the bearish side. Well, with efficiency ratio, the numbers are a little bit easier. Efficiency ratio, just like stochastics and MACD and %R, it is an oscillator, but it oscillates around 0. And so our overbought level is going to be positive 30. The oversold level, which I'll get to the bearish rules here in a minute, is negative 30. So you're really looking for price action on the bullish side above that positive 30 level to signal that you're in that